invited Alan Blood to be with us with CFG Home Loans and Capital Financial Group. There's a lot of questions in the market right now, so we thought we'd bring in one of our expert financial advisors. Alan is brilliant with this. Alan's helped, he's been a preferred lender of ours for 4 or 5 years now. So the big thing everyone's talking about now is rates. And before we get into all that, I just wanted to take a minute and have each of us introduce ourselves briefly and how long we've been in the business. And we'll start with Birk.
So yeah, my name is Birk Wolfgramm. I have been in the real estate industry pretty much 20 years plus, but I've been a sales agent in the last 6 years.
Cool. Where did you work before that?
And before that, I worked for a home builder, Ivory Homes, a local home builder here in town, and for the last year and a half at Bryson Real Estate.
Alan, what should we know about you?
Alan Blood, CFG Home Loans. I've been in the mortgage business for longer than I think. I count 26 years is what I count. Doing the exact same thing every single day. So I should be pretty good at it by now. I got my 10,000 hours in like 10 years ago. Studied economics and then went to law school and have been in the mortgage business ever since. So that's what we do. We help people with residential finance.
That's awesome. Okay, we're just going to get informal here and talk over what we think is happening in the market. The number one thing we're seeing right now from our clients is they're nervous about interest rates climbing and they think prices are just going to drop. And we're trying to pull out all the headline news of the sky is falling, the whole world's on fire, but technically the world is not on fire, and we have to kind of sometimes get rid of the cable news channels for a few hours to understand what's really happening in our market, especially in Utah. So Alan, what can you tell us is happening with rates, and what's your best advice for buyers right now?
Good question. And I'm going to comment on something first, Jared. I think one of the things that is challenging right now to get good information about anything, housing is a good example of this, is you're going to get exactly what you're looking for. And because of all the algorithms involved with social media or even just with internet searches. And so if you are looking at articles that are veered one way or the other, if you read something that says, oh, the housing market is falling apart, the whole world is falling into pieces, you're going to see more articles just like that. And so it becomes a self-confirming bias, and you start thinking that all of that's true,
right? Because
that's all you're seeing. And the reality is there's obviously multiple sides. So what's happening with your question, what's happening with interest rates? Wild ride with interest rates right now. Rates are up. We're sitting at just above 6% right now. For a good credit borrower, conventional loan, if you're buying an FHA or a VA type of financing, 5.625%. So a little bit better on those. The big driver for rates right now is inflation. As inflation goes up, so do rates. And what that's leading to is some action from the Federal Reserve and maybe some misperception there. So the Federal Reserve goes in and they raise their rates, they do different things behind the scenes to try and control inflation and employment. The Federal Reserve's job is not to determine mortgage rates. Their job is to maintain stable employment and maintain stable currency. In other words, try and not have too much inflation. So the rate that the Federal Reserve controls, it's called the federal prime rate. That's the rate that banks lend back and forth to each other for short-term debt. Car loans, credit cards, lines of credit are based off of this. Long-term debt, like mortgage financing, is based off an entirely different market, which is called the mortgage-backed security market, which is usually disconnected from the Fed prime rate. So generally speaking, when the Federal Reserve raises their interest rate or their prime rate, what they're trying to do is slow down the economy, which would theoretically decrease inflation. And if inflation goes down, long-term rates go down. So totally converse to traditional thinking, if the Federal Reserve is raising their rate, generally speaking, we actually see long-term rates come down. Now this year, that hasn't happened because we're dealing with a whole different set of issues, and that is inflation brought on not by corporate spending or by the economy really doing fantastic. It's being brought on by a lot of influx into the economy of outside money, in this case, COVID relief and PPP loans for business, and all this money that came into the economy from government spending that's very unusual. And it drove huge demand for different things, which is what caused the inflation in all reality, plus some geopolitical stuff and all the other things that's going on. But raising the rate isn't going to counteract that. And so as we're seeing inflation kind of fighting against the Fed, as there continues to be more federal spending, they're having to raise their rate further to try and get in front of that. So what to expect on that? The Fed's going to raise rates another 1.25% between now and the end of the year. That doesn't mean that interest rates are going to go up by 1.25%. What interest rates are going to follow is inflation. So if you see inflation rising, you're going to see rates rising. The flip side of that is the other thing that follows inflation is housing.
Yes.
I think everyone thinks that if inflation kicks in, then suddenly people are going to sell their house at a discount.
No.
And if inflation is coming in, I got to sell. And the reality is, inflationary markets keep people in their homes because you don't want to go and sell this house and then have to buy this house and have the same house. You're just going to stay here, and costs of good go up, cost of building goes up. So does the cost of your house. And so, even though rates might be tracking with inflation, so are the price of homes.
Right. And that's historically true through other inflationary times. Home prices generally do tend to go up. We've been through an influx now of 11, 12, 13, almost 14 years of just steady price increases. The last 2 years were absolutely phenomenal. I know here at the brokerage we've seen, I've sold one house 4 times in the past 12 years, and it's nearly doubled every single time.
Oh my goodness.
And that's just here a mile and a half from our business in Bountiful. But the other thing that we were talking about before we started filming, another trend we're seeing is where homes used to sell in maybe 2 or 3 or 4 or 5 days. Now maybe they didn't close in that time, but they were certainly under contract in that time. You're seeing it go out 5 or 6 or 7 weeks now before a home actually goes under contract. We just pulled statistics for kind of the median sales price for 2-3 bedroom home, 2-car garage here in Bountiful, and about 1/3 of those statistics show that 1/3 of those homes have sold. So it's about a 3-month inventory is what that translates into. Then we widened it out a little bit and we said, okay, Davis County, what are we seeing? It was just about the exact same. So a 3-month inventory means that if a home's on the market, it can literally sit there for 2 or 3 months before it's sold. But more importantly, it means if you're going to look for, let's say, a home between $480,000 and $600,000, you're not going to have just one home to look at and 12 other buyers. You're going to have maybe 3 other buyers in that category, but you're going to have 8 or 9 or 10 homes in that price range to look at. So buyers, it's a great opportunity for you to buy. Rates aren't as extreme as everyone's thinking, but it's a good opportunity to buy because you have more choices. In the spring, if the economy flips around, rates may actually dip and you'll see more people enter back into the market. So where you may pay a little higher interest rate now, you're not going to have as much competition, and you're probably going to get that home that was a 6 or 7 on your 1 to 10 scale. You're probably going to get the 9 out of 10 that you want because there's more homes to choose from.
I see a lot of people thinking either buyers think, oh, it's a buyer's market still, and sellers are still thinking, oh,
it's that bias confirmation, right?
Yeah,
you're
exactly.
Going to get what you're looking for.
Exactly. And from what we've been talking about and what we can see, it's a transitional market.
Yeah. And I think we keep hearing a recession market, a transition market, and the word that we heard yesterday we really liked from Windermere's chief economist was a reversionary market. We're reverting back to what was the norm. The sky's not falling, rates aren't falling, but they're not climbing to unexpected expectations either. So I think the summary of this, and you guys feel free to add here, the summary of this is it still is a good time to buy, and if you're selling, you need to kind of fix up those things that maybe you didn't have to the last 2 years to really make sure that 2 or 3 buyers buying in that price range see your home as the home to buy. We're talking about paint, staging, things like that. You're welcome to call us. We'd be glad to help. Alan quoted a few rates between 5.8, 6.5 in there. Nationally, you're hearing 7 and higher.
Yeah.
So Alan may be a good resource for you to call and see if it's time to maybe refi if you haven't refied in, probably 8 or 9 years.
Well, interestingly enough, I think
get into a new home.
The refi piece comes in where, because the economy was so good, I think people perceived that their personal economies were maybe even better than they really were. And they felt wealthy because they have a lot of equity.
Yeah.
And their car was worth more, and their house is worth more, and everything's worth more. And so people felt like they had money to spend, and so they did.
Yeah.
And now maybe it's coming to a point where the money that was spent on a variable interest rate that was 3% is going to be 6, and then 7 or 8 or 9%. And that becomes really expensive. So refinancing that debt in might actually be a good idea. Even though mortgage rates are higher, your overall debt payments could be less. The other thing I'd comment on this too is I think it's really valuable to have some perspective on this. We're talking about an inventory of 3 months. In 2017-18, when we had 3 months of inventory, everybody was kind of anxious about it because,
Yeah.
oh my goodness, homes are selling so fast now. Oh, we can only look for, if it's going to go under contract in 30 days or 60 days, we've got to make a decision. And it felt fast because prior to that, we'd had 5 or 6 months.
Right.
And 3 months felt like, boy, a really tight market.
Right.
Well, we're coming back to that. And so now we think, oh, 3 months of inventory, that's terrible. It's really not. It's actually a really healthy market. The other thing that I think you mentioned that's really worth highlighting is the impact of inflation and higher rates on home value. So a really good analogy is in 1979, interest rates were at 18% for a mortgage. Inflation clocked 12%, and homes in Utah went up by 21%. So the median home price that year, 21% increase, which is, by the way, the second highest increase in home value ever on record,
Wow.
except for last year.
So my whole lifetime ago, I was one.
Yeah, being driven for a little bit of a different reason last year. But an inflationary market doesn't curve down. I think everybody thinks we're heading into the recession of 2005, 2008.
Right.
And you always hear this, this time it's going to be different. Well, that was the aberration.
Right.
I think a lot of people are thinking, well, I'm going to wait for all these foreclosures that are somehow going to happen because of inflation or higher interest rates, and then I'll buy because it's going to bring prices down. Well, right now, the delinquency on mortgage payments is 1.75% nationwide. The delinquency on mortgage payments when we were in that housing recession was 10%. And as long as we have employment, which in Utah is very strong, you can't hire anybody. Everywhere you go, they're hiring somebody. They're paying more and more just to get somebody to show up to work.
Right.
So as long as we have a strong employment market, we're not going to see home prices go down.
So what do you think about the chance of someone buying now and say they get 6.5% interest? Is there a reality that maybe in May or June or July of next year, maybe after a 6-month time, that they could refinance even lower?
Well, I think there is. So Fannie Mae, who you'd think would know about mortgages, they're predicting that at the end of Q1 of 2023, so March, April I have to count down.
Yeah.
End of April, that rates are going to be around 4.5%. Again. Now, if they're right, which historically they tend to be accurate-ish, that's going to open up an opportunity. But here's the fallacy is people hear that and go, oh, well then I need to wait until then to buy. Because if rates are 4.5, I can afford so much more,
Right.
so I'll wait until then to buy. Well, the problem is, if you wait until then to buy, so did everybody else.
Yeah.
And if rates come down to that level,
You'll have
it's going
multiple
to
offers again.
so much activity, because what we've forgotten in the last month and a half is that we still have a housing shortage in Utah.
Yes.
We have 35,000 homes minimum fewer than there are households.
Right.
And so if suddenly we bring all those buyers back in because rates do go down, well, now you're back into a competitive bidding war and your price goes up.
Yeah.
So instead, I think a really good strategy would be if you can find a house, even maybe make an aggressive offer, right? Like reach out to your agent, reach out to you guys, make an aggressive offer that you feel is realistic, and you have some choices. So maybe you make an offer on more than one house.
Yeah.
If there's a couple that will work, because you can now, and get a home under contract, buy it with a payment that you can afford. Obviously, everybody wants a lower payment, and then plan on when the refinance window opens up again, take advantage of that, drop the rate down. But now you've captured the home at what is probably a little bit of a lower price now. I think there maybe is a window of opportunity for buyers to be a little aggressive with builders right now.
I agree. So 2 things we've seen on that side is there's a national builder here locally in Davis County that has lowered every home in their subdivision of their specs, nearly $58,000 to $60,000 of all their specs. Now, if you're going in and get a loan, obviously check with their preferred lender, but also check with an outside lender like Alan, who oftentimes can get discounted fees and maybe no fees for you. And then try and get in by the end of the year. A lot of people don't know that all the builders are trying to get all their permits done and get their certificates of occupancy and close homes by the end of the year, because it makes them look better on their annual reports.
They've got to hit their quarterlies.
Yeah. Now, speaking of refunding deposits, we're working with a client right now, and there's a local builder also here in Davis County that it literally says in their contract that your deposit's non-refundable no matter what. Now, some of them are 30 days, some of them are, you give us $5,000 down now, it's non-refundable. They want that much of a commitment still. I think those things will start to change. But right now, if you've got some cash to put down, or even you're a cash buyer, let's go after these new home builds. Some of them have homes ready to move in, or for sure by Christmas. So if you're looking for a new home by Christmas, we'd be glad to help you.
I think really the takeaway for me that I hope people hear is don't get caught up by the hype.
Yeah.
Don't.
The
Is
yelling
that a
and
song?
screaming,
Don't believe the hype,
Don't
right?
believe the hype.
Don't get caught up by the headlines. A perfect example of that headline, one that came out in the news publication here in Utah last weekend, that was hype, that was going on about how bad the real estate market was, and that homes were on the market for 3 times longer than they were last year. And by the way, last year they were on the market for 7 days, and now you have to take 22 days. I mean, a healthy market should be 4 or 5 months of inventory, and that's always been the traditional fact.
Yeah.
So I think just don't get caught up into the sounding chamber of your social media, ironically, or so that you're not just hearing the same thing over and over again to the point you believe it's true. You got to reach out a little bit and make sure that you're using actual data to make your decisions rather than the clickbait and the headline.
Perfect. Love it. Okay, we'll see much more of you, and we're hoping to kind of launch a few channels off of this and be your local experts. If you have any questions, give us a call at 801-922-HOME, 801-922-HOME, and Alan, how can they reach you?
Reach out to me online or go to call me up is probably the best way, 801-298-5887, or you can visit us at cfghomeloans.com.